Hello everyone, this is Professor Kent and today's recording is Chapter 4 Consolidation of Non-Wholly Owned Subsidiary. No, the word here is non-wholly owned subsidiaries. In this chapter we're going to learn the theory, and then first we're going to learn the theory, and then we're going to apply that theory by doing some of the question at the back of the chapter. So I will do one recording for this and maybe couple recording for the questions at the back of the chapter, because some of the questions are long and it takes a little bit longer to do that. But before we get to that, why do we call it wholly owned subsidiaries? When a parent acquires less than 100%. If we own less than 100% of another company's shares, um, the parents the parents the parents own asset and liability, and the parents share of subsidiaries asset and liability will be measured at carrying value and a fair value. So your own asset will be measured at a carrying value. Whatever you owned from another subsidiary, they will be recorded at a fair value. That's what the whole paragraph is talking about. Now when we do non-wholly consolidation balance sheet, we needed to see the example of it. If I were to think about it, this is my parent company, and then what we do is this is my sub company. So when you're doing a consolidation, you take the carrying amount of the parent, and for the sub you have both carrying and a fair value. And what we look at we look at the fair value of the asset and the fair value of the liability to do a consolidation balance sheet. So that's what the first paragraph was talking about. This is the first paragraph. It's describing it as a visually to see it. In that exhibit 4.1, when we think of a non-wholly owned subsidiary, the shares are not acquired by a parent, the parents are owned by the other. So whatever so if it's less, this is 100%, some are owned by parent and some are owned by another corporation. That's what happens. So what happens is these shares are not acquired, parents are owned by other shareholders. So if we own 80%, 20% of that company is owned by other shareholders, and they're called non-controlling shareholders. Going further, the value of the shares held by non-controlling. So we're talking about the 20% that are not owned by us, that is non-controlling shareholders, appears on the balance sheet as a non-controlling interest. Short form is NCI. NCI is a short form, non-controlling interest. In this case, the example that I used, 20% is a non-controlling interest. Now going further, there are three questions arises when preparing consolidation for financial statement for less than 100% subsidiary. It could be anything less than 100%, 80, 90, 99%, 10, 90, not 99, because then it'll be almost fully owned. So then first question that we have to ask, how should the portion of the subsidiary's net assets not acquired by the parent be valued in consolidation? So we wanted to know, should the portion of the net assets not acquired, so whatever we did not acquire, how should we value them on the consolidation? So how the NCI be measured, how should they be shown? So these are the first we wanted to know how should we account for, then how should we measure them, and how do we present them on our financial statement. In order to do that, in order to find a solution for this, is we needed four different methods to do that. Now we have, first one is proportionate consolidation, second one is parent, third one is identifiable net asset method, and the last one is fair value enterprise method. When you think of it, these are my four methods. So this is my number 2, this is number 3, and this is number 4. So when we own proportion of subsidiary, and this is how it's going to be presented. So now it's a proportion. So when you do it, you have a parent and non-controlling interest. Non-controlling interest is the interest that is the shares that are owned by another shareholders. So you take the carrying amount, then the fair value, access, and then you will have a goodwill. So this is how you record them. So then what happens in this case, this is how you learn um, what should be put in there. So you have a carrying amount. When you think of it, I just want to change the thing here. So this is a carrying amount, also this is carrying amount, this is the carrying amount. These are all carrying amounts. That's what they're saying. So some you use a fair value, some you don't do a fair value. The parent's portion of all subsidiaries value is fully represented under all method. The NIC shares varies under the 4. So the only part we needed to worry about is the NCI portion of it under the each method. So that's what happens. So this is the only change. But if I were to think about parent is exactly the same. What we are doing under every method, parents is exactly the same, only the NCI is different. That's all there is. So that's what we're looking at, and we're going to apply it when we learn the questions at the back of the chapter. Now going further, this is our first one is my consolidation method. So it's the first method is a consolidation. So we're going to talk about each of the methods. But there's one method that is not used in this book, and if it's not used in this book, we're not going to be learning about it. Now we will illustrate the preparation of consolidation financial statement under these methods using the following example. So now let's look at it, how we journalize it. If we were using a consolidation method, I didn't brought in all the examples, only I brought in small examples. Now P limited, we will examine P limited and S limited. So there's parent and there is a sub. Both company have a June 30 fiscal year end. On June 30 year 1, S limited had 10,000 shares outstanding and P purchased 8,000. Sometimes they don't tell you 80%. Now we have a P and S. S had 10,000 shares. We parent company purchased 8,000 of that, and what we have is the parent own 80% of sub. That's what it means. For the total cost of 72,000. So we needed to do a journal entry. Debit will be investment in S and credit will be a cash. For how much? For 72,000, and we P owns 8,000 shares. Now going with the same under proportion consolidation method, views the consolidation entity from the standpoint of the shareholders of the parent. So we're thinking of a parent own 80% of sub. Now therefore the consolidation statements do not reflect the equity of non-controlling. So there is no non-controlling interest on the equity. Think of it as non-controlling interest. So there's nothing under non-controlling interest but here you have some non-controlling interest, some non-controlling interest, and some non-controlling interest. So this table is a good example when you're doing the questions at the back of the chapter. Now the consolidation balance sheet on the date of acquisition, only parent shares of the asset and liability of a subsidiary based on their fair value and the resultants goodwill from the combination. So what we have is we have a goodwill when we purchase asset and liability of a subsidiary. Of course we have an asset minus the liability, that's net identifiable assets, and whatever if we pay more we have a goodwill, if we pay less we have a negative goodwill. That's what it means. Now The proportionate consolidation focus solely on the percentage interest in the subsidiary. So we own 80%. We only going to take 80% of the sub when we are doing consolidation statements. Proportion consolidation is not used in practice to consolidate a parent and a subsidiary. However, it is used to report certain type of a joint agreement. So there's a joint agreement between the parent and the sub. That's what it means. Going further, the second method is the parent company method. It is no longer used in practice. If it's not, it is a method that we used to use it before. If it's not long used anymore, we are not going to learn about it if it's not used anymore. Fair value, this is the third one, is my fair value enterprises. So short is FVE. That's what it is. View the consolidation entity as having two distinct group of shareholders, the controlling and non-controlling. So we said that S has 100%, S, this is S limited, parent owned 80%, non-controlling interest is 20%. That's what they mean. So parent owned 80%, 20 is owned by non-controlling shareholders. So they said this is separate and this is separate under the fair value method. The fair value enterprise method gives equal attention to the controlling. So it looks at controlling interest, it looks at non-controlling interest. The trading price of subsidiary share or share of a comparable company in active market is probably the most accurate reflection of the value of NC. We want to know what is the value of this NCI, and what we use it, we look at the fair value. When we think of a fair value, we look at the price of the company that is in the similar business as this one. So what we have is, if and an investor typically in this type of thing, it typically pays a premium over the trading price. If the shares are trading at, let's say, $6, we will pay more, so we will pay 7.50. So if they're trading at 6, we will pay 7.5 to take over the company, and that's to obtain the control of the company. And sometimes what we do is we use a discounted cash flow analysis. Means you can present value the this is what we discounted cash flow is, when you present value the future cash flows. That's what it means. Now we're going to address the goodwill. In this case, address concerns about goodwill valuation under the fair value method reflects both parent and non-controlling interest. 80% is parent owned by that, and 20% is non-controlling interest. However, only parent share of subsidiaries goodwill is reflected. So we don't care about the goodwill on the non-controlling interest. We only care about the parent shares of the goodwill. Now, when we think of, you could have two types of goodwills. One is a positive goodwill, and the other one is negative goodwill. If you need an entry on the debit side when you're purchasing the net asset of another company, it'll be a debit, will be a goodwill. And if it's a credit, it will be treated, if you think about it, it treated like a gain. We treat it like a gain. Here we have it treated like an asset when you have a positive goodwill. Now, often described as a bargain purchase option. So this is our third method. So occurs when shares are depressed or shareholders have had a recent operating losses. So bargain purchase when you think of a bargain purchase, it's less than what they're worth. That's what bargain price is. Now what happens is that I already talked about it. So what we have is, we could have a positive goodwill and negative, and also negative goodwill. Now when we have a it says the requires that negative goodwill be reduced to 0 by first reducing any goodwill on subsidiaries books, then recognize any remaining so now negative goodwill, if I were to think of it, negative goodwill is treated like a gain and positive goodwill is treated like a goodwill. So if you are going to do a debit, it will be a goodwill. If you're going to if you're putting on the credit side, it will be a negative gain, and if it's a negative goodwill, it will be treated like a gain. But it is very rare. Parents should check the now when there's a negative goodwill, you need to check the valuation to see if you didn't make any mistakes. If you made mistakes, that needs to be fixed. Going further with subsidiary with the goodwill, any goodwill on the balance sheet of a subsidiary on the acquisition is not carried forward to the consolidation. So if there was a goodwill when you were purchasing the subsidiary, you ignore that goodwill because that's not the goodwill you can take. You ignore that. You only calculate the goodwill. You look at the asset, you look at the liability, that's your net identifiable assets, and then the price you, if there were in the asset there is a goodwill, you ignore that. That is not going to come part of the consolidation. This the reason why you have this goodwill is because of a past transaction in which subsidiary was acquiring in a business combination reflecting outdated fair value on the entity. Now going further, they say analysis and interpretation of financial statement. How do you look at how do you analyze the financial statement? So what we do is we learned in the previous accounting courses, we do ratios. That's what we do it. So then that's what we do, the key ratios, and we also analyze the value and classification of NCI. NCI, non-controlling interest, is significantly different under the three methods. So the three methods, there's four methods, but we ignore we ignore the parent company method. So there is no non-controlling interest when we don't need to do it when it's a parent company method. We only look at the consolidation, identify net asset and method, and fair value method. I keep going back to that page, that PowerPoint, because that is one of the most important PowerPoint that we have. Going further, the classification of non-controlling interest has a big impact on debt to equity ratio. So what happens is that because debt to equity ratio describe um, of course the debt over the equity, if you have a non-controlling interest, it impacts that ratio. So when you're doing consolidation, we call it a working paper approach. What you have to do is, you've seen it before, we have unadjusted trial balance. This is what it means. Worksheet is unadjusted trial balance. Then we have adjustments, and then from there we do adjusted trial balance. So this is what we do is, in these adjustments we are going to debit some account, we are going to credit some account. So that is called this is called the 8-column worksheet that you have seen it before in your other accounting courses. So this is what we use when you do a consolidation. You do debits and credits, but at the end you need to post these entries to worksheet. Is for working purposes, but it's not a final copy. Then they said that paper ensures that the debits and credit adjustments balance each other. Of course, when you do an adjustment as an accountant, we know that we needed to do debits and credits, and they have to balance. Otherwise, my trial balance won't balance my statement of financial position and statement of income. There, nothing is going to balance. So going further, when you're doing a working paper, what we need to do is we need to do these three things. And what are the three things? First is we're going to establish the NCI on the balance sheet, on the consolidation balance sheet, and adds the additional value to the investment account, which includes both parent and non-controlling proportion interest. Second is we call it eliminates the investment account, because one has a debit, one has a credit. We eliminates that. And the subsidiary shareholders equity account with the difference established at the acquisition or differentials. The third one is you allocated the acquisition differential to revalue the identifiable assets of the subsidiary to fair value, and then you're going to do a goodwill. So this is some of the methods that we have, but we are going to do the questions at the back of the chapter to understand this. This is just a talking about it, and sometimes when you talk about it, it doesn't make too much sense. When you apply the knowledge that was learned in the chapter, it makes it better to understand the material. I'm going to stop here, and I'm going to do a recording, maybe 2 videos for the homework. Thank you so much for listening to me, and thank you for subscribing to my channel, and thank you to liking my video. Thank you for making comments on the video. Really appreciate that. Thank you for your time, and take care, and bye for now.